The relationship between money supply and exchange rates is a crucial concept in international economics that can significantly influence global trade, investment, and economic stability. Understanding this relationship requires a fundamental grasp of how monetary policy, the amount of money circulating in an economy, and foreign exchange markets interact. In essence, national currencies and their values fluctuate based on factors such as economic performance, inflation, interest rates, and importantly, the money supply and circulation. Money supply refers to the total amount of monetary assets available in an economy at a specific time. Central banks control the money supply through various mechanisms including open market operations, discount rates, and reserve requirements. These tools allow central banks to influence economic activity by either expanding or contracting the money supply. For example, when a central bank increases the money supply, it generally aims to spur economic growth by lowering interest rates, which can lead to increased borrowing, spending, and investment. Conversely, reducing the money supply can help control inflation but may also lead to slower economic growth. Exchange rates, on the other hand, determine how much one currency is worth in terms of another. They are influenced by a variety of factors including inflation rates, interest rates, political stability, and overall economic performance. A vital element in this exchange rate landscape is the relative value of currencies, which is directly impacted by each country's monetary policy and money supply. When a country increases its money supply, the additional currency in circulation can lead to depreciation against other currencies, assuming other factors remain constant. This movement illustrates the basic principle that more of a currency in circulation can reduce its value. The linkage between money supply and exchange rates reflects the economic theory known as the quantity theory of money, which posits that there is a direct relationship between the money supply and price levels, with implications for exchange rates. When a country excessively increases its money supply, it often leads to inflation. As domestic prices rise, the purchasing power of the currency diminishes, leading to its depreciation against foreign currencies. Therefore, monitoring the money supply is vital for understanding and predicting exchange rate movements. In an interconnected global economy, the actions of one nation's central bank can have profound effects on other countries. For instance, if a major economy like the United States increases its money supply through quantitative easing, the value of the US dollar can be affected, thus influencing exchange rates globally. Other countries may then adjust their own monetary policies in response to stay competitive. This kind of dynamic illustrates the importance of international cooperation and coordination in monetary policy, as unilateral actions can lead to currency wars or destabilization of exchange rates. Furthermore, capital flows also play a significant role in the relationship between money supply and exchange rates. A country with a growing money supply may attract foreign investment if investors believe that the economy will grow, despite concerns about inflation. Increased demand for the domestic currency to purchase investments can lead to appreciation, countering some of the devaluation impacts of a burgeoning money supply. Thus, while an expanded money supply can lead to depreciation, the resultant capital inflow can mitigate or even reverse this expectation through increased demand for the currency. The complexities intensify with the emergence of digital currencies and decentralized finance. The advent of cryptocurrencies and their unique supply mechanics has introduced new variables into the money supply exchange rate equation. As digital currencies exert their influence in financial markets, traditional money supply theories may be challenged, requiring economists to rethink existing frameworks. The value of cryptocurrencies is often tied to market sentiment and speculative trading, making the exchange rates of these digital assets highly volatile. On the domestic front, central banks must navigate concerns around inflation and unemployment while managing the money supply. The effects of monetary policy decisions can have immediate ripple effects on exchange rates. For instance, if a central bank signals an intention to tighten the money supply, expectations of higher interest rates could lead to an appreciation of the currency. In contrast, if the central bank adopts an expansionary stance, the corresponding depreciation of the currency can have broad implications for import costs, export competitiveness, and overall inflation within the country. The interplay between money supply and exchange rates is a dynamic and multifaceted relationship that holds significant implications for global economics. Policymakers must carefully consider the potential effects of monetary policy decisions, not just within their own borders, but in the context of an interconnected global economy. As economic landscapes evolve and new financial technologies emerge, ongoing research and adaptation will be essential in understanding the relationship between money supply and exchange rates is a fundamental aspect of economic theory and practice. Money supply refers to the total amount of monetary assets available in an economy at a specific time. Exchange rates, on the other hand, represent the value of one currency in relation to another. Understanding how these two variables interact is crucial for policymakers, economists, and businesses operating in a global economy. The mechanisms through which money supply influences exchange rates, the implications of this relationship, recent developments, and potential future insights. The money supply in an economy is controlled by central banks through various monetary policy tools, including interest rates, open market operations, and reserve requirements. An increase in the money supply often leads to lower interest rates, as there is more liquidity in the market. In contrast, a decrease in the money supply generally raises interest rates. This dynamic plays a crucial role in how currencies are valued in foreign exchange markets. The connection between money supply and inflation is a key part of understanding exchange rates. Inflation occurs when the prices of goods and services rise, often because there are more dollars chasing the same amount of goods. If inflation expectations rise, currency holders may demand higher returns to compensate for the declining purchasing power of their currency. Consequently, this can lead to a further depreciation of the currency in the foreign exchange market. To illustrate, the hyperinflation experienced in Zimbabwe during the late 2000s serves as a stark example. The government printed excessive amounts of money to finance its budget deficit, leading to astronomical inflation rates. As a result, the Zimbabwean dollar lost its value drastically. International traders and investors lost confidence in the currency, leading to a collapse in its exchange rate against major currencies. Interest rates are another critical avenue through which money supply influences exchange rates. When a country raises its interest rates, it becomes more attractive to foreign investors seeking higher returns on their investments. This influx of capital can lead to an appreciation of the domestic currency, as foreign investors need to purchase the local currency to invest. Conversely, if a central bank lowers interest rates, the money supply may increase and the economy might become less attractive to investors. In this scenario, capital may flow out of the country, leading to a depreciation of the currency. For example, in 2020, amid the COVID-19 pandemic, many central banks, including the U.S. Federal Reserve, cut interest rates to stimulate their economies. As a result, the U.S. dollar experienced a temporary depreciation against other currencies, while currencies in countries with higher interest rates, such as those in emerging markets, became relatively stronger. Expectations about future monetary policy decisions can significantly impact exchange rates. If investors anticipate that a central bank will adopt a more expansionary monetary policy, they may sell the currency in anticipation of depreciation. Conversely, expectations of tighter monetary policy can boost currency value as investors seek to take advantage of potentially higher yields. Recent developments, such as the geopolitical tensions and potential economic recovery following the pandemic, also illustrate the importance of expectations. For instance, when investors perceived that the U.S. economy was rebounding more swiftly than others, it bolstered confidence in the U.S. dollar, leading to its appreciation. This belief in the economic strength was grounded in the monetary policy direction of the Federal Reserve. In today's interconnected economy, money supply and exchange rate dynamics are further complicated by globalization. Capital flows across borders occur rapidly, and decisions made by one central bank can have ripple effects globally. For example, when the European Central Bank initiated a quantitative easing program, it affected not only the euro but also the exchange rates of emerging market currencies. Investors may reallocate their portfolios in response to changes in monetary policy in major economies, underscoring the interconnected nature of modern finance. Emerging markets are particularly affected by changes in money supply and interest rates in developed countries. When the U.S. Federal Reserve increases interest rates, capital tends to flow back to the U.S., causing currencies in emerging markets to weaken. This situation can lead to economic instability as debt denominated in the relationship between money supply and exchange rates is intricate and multifaceted. Changes in the money supply directly influence inflation rates, interest rates, and investor expectations, all of which play critical roles in determining exchange rates. Recent developments, particularly in light of the global economic challenges posed by the COVID-19 pandemic, highlight the importance of understanding this relationship for policymakers and businesses alike. Furthermore, as the global economy continues to evolve, the implications of money supply on exchange rates will remain a key area of study and consideration for maintaining economic stability and fostering growth. Future trends, particularly those related to monetary policies in response to emerging global challenges, will likely continue to shape the dynamics of exchange rates in an increasingly interconnected world. Thanks for watching. If you found this helpful, don't forget to like, subscribe, and hit the bell so you never miss a money tip. Drop a comment below with your thoughts or questions. I'd love to hear from you. Until next time, stay smart, stay savvy, and keep building your financial future.